Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Thank you very much for visiting our YouTube channel. Hope you enjoy this video, and if you like it, please give us a thumbs up. So today we're going to look at the key assumption driving my analysis. Look at the weight of the evidence for the S&P 500. We're going to look at this current bounce, compare it to prior bear market bounces, and see where we are now as a meeting lines candlestick pattern forms. So what is the single most important factor to consider before investing or trading in stocks? I would suggest you need to figure out if we are in a bull market or if we are in a bear market. And what is the most important index to use to make that decision? And I'm giving it away right here because I've got the S&P 500 SPDR chart up right here. So either SPY or the S&P 500 is the main index to use when you're evaluating the stock market. Yeah, blah, blah, blah. I know they say small caps are the canaries in the coal mine, and the value line geometric average is the most equally weighted index out there. Well, the S&P 500 captures 80% of the total U.S. investable market. It is by far the most widely followed benchmark for U.S. stocks, and these are the stocks where the institutions are the most active. And you need to follow the big money because you don't have a real bear market until the S&P 500 is in a bear market. And so I think we're in a bear market environment because the bulk of the evidence on this chart is clearly bearish. If we look at what's happened here, I've got the 40-week moving average. We broke it with a long black candlestick. We had a gap down as well and broke a minor support level at the time, but we closed well below that 40-week moving average. And then we tried to get back above the next week and close below it for 2 weeks in a row. So that was a bearish signal right there, that deep cross below the 40-week with 2 weekly closes. And then you can see the 40-week is now trending lower. It's moving down. So you have a falling 40-week moving average. And then you can see 5 weeks ago, the 4-week moving average crossed below the 40-week moving average. And that is illustrated with the PPO 440. And you can see that happened in October, and we stayed negative until we got a cross in early February. So if you're using moving averages, like 2 moving averages, you're going to have some lag in your signals. And if you're just using a moving average, you're going to have some whipsaws because you can see we crossed below the 40-week here and we crossed below the 40-week here. So there's always a trade-off. But clearly, you know, this gap down, the support break, the deep cross below the 40-week, those were bearish. And whether they were bearish then or not, you can debate. At the time, maybe you thought something different, but right now the bulk of the evidence is bearish. And so if we're working under that assumption, what does that make this bounce here? That makes it a bear market bounce. So you don't expect the market to go straight down, even though we had a crash, but we do get bounces in bear markets. And I think this is a very unusual bear market in the fact that we had a 33% decline. But I still want to go back and look at some other bear market bounces to see where they ended and reversed. So way back on March 13th, which seems like an eternity in this day and age, but it was like 3 weeks ago, on TrendInvestorPro.com, I put together a video studying past bear markets and looking for clues and setups going forward. And I covered the sector breadth model. And you can see everything was turning bearish in late February. And some of the weighted signals was 100% bearish in late February. And I was also looking at the bear market bounces. And that's what we'll get to here. But here's a zigzag chart of the S&P 500 showing 20% moves that were 20% or more. And the S&P 500 is invisible on this chart, but it goes back, you know, to the 20s there. And there you can see after the 29 crash in the bear market, we had a number of 20% bounces. I'm not saying we're at 29 right now, We can see here in 2001, 2002, we had 1, 2, 3 bounces of 20%. And we can see in 2008, we had 2 bounces of 20%. That was, of course, the financial crisis bear market. And this was after the dot-com bubble burst. So let's look at a couple of these bounces here during these last 2 bear markets to see where they failed. So here's the bear market in 2000, 2001, 2002, and we can see 3 bear market bounces along the way. Now, I'm not saying this is the path we're going to follow. I mean, clearly this is an exceptional market we're in right now, and the fact that we had a 33% decline, we almost had a 20% advance the last 11 days. So this one is like hyperactive bear market on steroids, if you will, looking at the size of the moves. Here's just your normal garden variety bear market, if you will. But you had that first move down, and then you had a bounce that was around 20%. We had 3 20% bounces roughly during this 2000, 2001, 2002 bear market. And you can see that this first bounce retraced 50% of the prior decline. Here's the second decline, and the second bounce retraced between 50 and 61.8%, and it failed at the falling 200-day moving average there. This one also failed just below the falling 200-day moving average. And you can see we got a decline, looked like we're breaking down, and boom, you get a breakout and a move back up to that high and back above the 200-day. Man, what a sucker rally that was. Geez. And then we're right back down. We didn't clear this high, though, note. And we're back below the 200-day, and then we get the steepest decline of the bear market. That is a very sharp decline. We get a 21.5% bounce that retraces just over 38.2%. And then you get a sharp move to new lows. So you can see during this bear market, we had 3 counter trend bounces that retraced between 38.2 and 61.8% of the prior decline. And if you look at the indicator window, you can see that the danger zone for RSI is that 50 to 70 zone, because when you get into that 50 to 70 zone, you're getting into the momentum resistance zone, if you will, because momentum usually doesn't get above, RSI doesn't get above 70 in bear markets. It gets below 30 in bear markets. You can see a number of moves below 30 as prices move lower and lower and momentum increased on the downside. But with each bounce, you did not get above 70. And so if RSI 14 moves above 50, you're getting into a danger zone. So here is the S&P 500 during the 2008-2009 bear market, and we had 4 bear market bounces. You can see we had the initial decline and breakdown, and then we had a move back to the 200-day that retraced around 50%. And then we had another move lower. And then we had another bounce that retraced around 38.2%. And you can see both of these form rising wedges. These were picture-perfect bounces, and then the breakdowns led to some nice declines if you were going short or buying an inverse ETF. And then there's the crash in 2008, and we got these bounces, but it was more like these huge 10% swings. You can see the zigzag is inlaid there. So we had a 10% bounce, 10% decline, 10% bounce, 10% decline, 10% bounce, 10% decline, 10% bounce, and then a move to new lows. So, there's the move to new lows there. And then we had another retracement that exceeded the 61.8% line. But you can see from these that once you get into that 38.2 to 61.8% zone, that's where retracement bounces or bear market bounces tend to reverse. And if you look at RSI again, there's that 50 to 70 zone. You get above 50, that's caution. The closer you get to 70, that's the more danger. And you can see we didn't even get close to 70 there in August, September. and we didn't get close to 70 there in January 2009. So that's why, RSI gets oversold in downtrends and bear markets. It gets overbought in uptrends and bull markets. So also note in this report, I showed how these bear markets ended as well. This is a chart from 81, 82 showing how the bear market ended, but I don't have time to go over those here now. Now, in those previous charts, I showed the 38.2 and the 61.8% retracements. Those are the Fibonacci retracements. Truth be told, there's no magic in Fibonacci numbers. Charles Dow, 100 years ago, said that secondary moves, so basically you have a primary move, which is the direction of the bigger trend, and then you have secondary moves, and those run counter to the bigger trend. And this is a secondary move, I think. And he said secondary moves retrace 1/3 to 2/3, with 50% being your base case, if you will. And so if you look at it that way, here we retraced 33%, and we almost retraced 50% on the high on Tuesday. But, this 33 to 50% zone is kind of like the caution zone. And this is really the red zone. When you get above that 50% retracement on a bear market bounce, that's really a danger zone that we're going to get a reversal. Caution zone in that 33 to 50% retracement zone. Now, I also noticed that we had candlesticks form. And we also had a meeting lines candlestick pair in late February. And that's when you can see this low meets the two closes meet, basically. So there's the close of the black candlestick. There's the close of the white candlestick. They didn't exactly meet, but close enough. And technically, they're a reversal pattern, and technically, you should get a bounce. But I went to Thomas Bulkowski's website, Chart Patterns, the pattern site, I believe. I'll take you there right now. So Thomas Bulkowski, of course, wrote the Encyclopedia of Chart Patterns. He also wrote an Encyclopedia of Candlestick Charts, you can see here. And he backtested some. This is the patternsite.com. And what I was interested in was the back test. And so here's what he says, tested performance, bullish continuation 51% of the time. So that means instead of being a reversal pattern, they marked a continuation higher 51% of the time. But basically they work half the time. So 49% of the time they marked a bearish reversal, 51% of the time they marked a bullish continuation pattern. So, candlestick patterns are short term. And overall, 50-50 is around the batting average on these candlesticks. So returning to the chart for SPY, we can see here that we have meeting lines. Basically, the closes are almost equal. So you had a strong open and a weak close here. And more importantly, I think we have a rising wedge, which is typical for counter trend bounces. It's a bear market bounce, I think. And if we break down here, then that's going to signal a continuation lower. But I would caution volatilities in the stratosphere. The Fed is pumping to infinity and beyond. Fiscal policy, Congress is going to come out with another package probably. So there are lots of things that are going to move this market up and down. So just be prepared for some volatility. So that concludes this video. Thanks very much for visiting our YouTube channel. If you like this video, please give us a thumbs up or leave a comment below. Again, thanks very much for tuning in and have a great day.